If you ever receive a sudden financial windfall, a $100,000 bonus, an inheritance, or the proceeds from selling a business, you face an immediate and paralyzing choice. Do you invest the entire amount immediately in one lump sum, or do you invest it gradually over the next year in monthly installments, a strategy called dollar cost averaging, DCA? This moment of paralysis is where rational math gives way to primal fear. Nearly every financial guru, online forum, and personal finance book will give you the same unanimous advice. Dollar cost averaging is the safer, smarter choice. They argue it removes emotional risk, protects you from investing right before a crash, and is the prudent path. This advice is repeated so often it has become gospel, a comforting mantra for the financially anxious. But I'm here to tell you it is one of the most mathematically dangerous pieces of dogma in personal finance. My name is Andrew, and I spend way too much time analyzing investment data that proves common wisdom is often just common complacency. If you're someone paralyzed by the fear of investing at the wrong time, make sure to hit subscribe, because today I'll show you overwhelming historical evidence proving that lump sum investing, LSI, beats dollar cost averaging roughly 70% of the time. I'll expose the false sense of security DCA sells you and explain why your biggest enemy isn't market volatility, it's the opportunity cost of time. The core flaw of the DCA mentality is psychological. We love dollar cost averaging because it's designed to protect our ego, not our money. We fear the emotional pain of investing $100,000 today only to see the market drop 10% tomorrow. We crave the guaranteed security of knowing we didn't buy at the peak. DCA acts as a financial security blanket, promising you'll buy at some peaks and some valleys, averaging your cost. But this emotional comfort comes at an enormous calculated price, the surrender of compounding. When you choose DCA, you intentionally keep a large portion of your money, perhaps $90,000 of that original $100,000, sitting on the sidelines in cash or a low-yield savings account. You are waiting. Every single day that money waits, it is being eroded by the one force no investor can beat: inflation. We just discussed the Cantillon effect, and you know what sitting in cash does to your wealth over time. The market is a flawed and brutal machine, but it is the only one designed to reliably grow capital faster than the central bank can print currency. By keeping money on the sidelines, you guarantee it loses that race. This is the psychological tax we pay for the illusion of control. We think we're mitigating risk, but we're simply swapping the tiny, manageable risk of short-term market fluctuation for the guaranteed long-term erosion of purchasing power. Historically, the market goes up far more often than it goes down. Studying nearly a century of S&P 500 data, the market finishes the year higher roughly 3 out of every 4 years. When you choose to DCA over a 12-month period, you are placing a tactical bet that the market will crash in the immediate short term, a bet the data proves is wrong 70% of the time. This isn't emotion, it's pure mathematical fact, rooted in the relentless upward momentum of the global economy. Think of it this way: your money's greatest superpower is time in the market. That's the engine that drives compounding, the closest thing to magic in finance. When you choose DCA, you intentionally strip your money of that superpower for 12 months or more. You force the majority of your capital to sit on the bench while the market runs the clock. If the market rises during those 12 months, which it usually does, you miss out on compounding all those gains on the $90,000 you kept in cash. The market doesn't wait for your comfort level. It rewards participation. The true risk isn't investing before a crash. The true risk is the opportunity cost of the 70% of the time the market went up while you were waiting. This is the safety trap. You protect yourself from a small, short-term sting, but guarantee yourself a long-term mathematical disadvantage.
Now, let's address the one scenario where DCA truly shines: the Great Crash. Yes, if you invest $100,000 today and the market immediately drops 30% tomorrow, you will feel awful, and DCA would have cushioned that blow. This is the 30% risk that paralyzes us, the fear DCA successfully mitigates. But you must zoom out and look at the long-term outcome. In those rare periods where lump sum investing loses to DCA in the first year, studies show a fascinating pattern. The lump sum investment has often already regained its lead by year 5. Why? Because the money invested early, even if it fell in value, bought more shares overall. When the recovery inevitably begins, the lump sum investor owns a significantly larger stake in the market and benefits more fully from the eventual bounce. Think of it like buying a large apartment building right before a temporary local recession. You bought at the top, and for a year, your value is down. The DCA investor only buys a few small units during that time. But once the recession ends and rents recover, the person who owns the entire building, the LSI investor, generates exponentially more wealth than the person who owns a few scattered units. The LSI portfolio is built to benefit from recovery far more efficiently. The DCA investor trades long-term gain for short-term reassurance. The solution to this dilemma isn't a blanket rule, it's a discipline. You must differentiate between money for short-term use and money for long-term compounding. First, understand your time horizon. If you need the money in less than 5 years, neither LSI nor DCA is appropriate. That money belongs in cash, protected from the market. However, if the money is for a purpose 5, 10, or 20 years from now, your entire mindset must shift. Your duty to that capital is to place it immediately where the highest mathematical odds are in your favor, in the market. Second, if a massive windfall gives you crippling anxiety about an immediate lump sum, compromise, but never dilute. The goal isn't psychological perfection, it's mathematical superiority. Don't drag your investment out over 12 months. Instead, consider this compromise. Invest 50% of the money immediately as a decisive lump sum. Take the remaining 50% and invest it over the next 2 to 3 months on a predetermined schedule. This still captures the majority of the market's upward drift while satisfying your psychological need for caution by drastically reducing the time your capital is sidelined. The greatest myth in personal finance is that there is a safe way to get rich. The market does not reward safety. It rewards participation and discipline. It rewards those who understand that time is their most valuable asset. Every day you wait is a day the market has a 2/3 chance of moving away from you. Stop paying the price for safety. Stop letting your fears strip your capital of its greatest advantage. If you have money you logically won't need for the next decade, your duty is to put it to work immediately and let compounding do its job. Hit like if this video exposed a strategy you've always followed but never questioned. Subscribe to Andrew for more ways to hack the system and build long-term wealth. I'll see you in the next one.